welcome back to the Daily Dive. Today we are joined by Jaime Rogozinski, author and founder of the subreddit WallStreetBets. Hey Jaime, welcome to the Dive.
Hi, thanks for having me.
So last year you published a book called WallStreetBets, How Boomers Made the World's Biggest Casino for Millennials. What was your motivation for writing the book?
To be honest with you, I've been having throughout the years the motivation to write little bits and pieces of it. I started gathering my thoughts early in 2012, 2013, around the time that WallStreetBets started, because I was fascinated by ETFs and specifically the leverage type or the ones that are synthetic and allows people to short, because I found it fascinating that they have these tools that would allow people to trade things that are very complicated and sophisticated, and it was a way for them to bypass, for retail traders to bypass certain regulatory restrictions that were in place. So I kind of had the idea back then, and it just continued to brew. And I finally decided to put it all into words and publish it this year because, it was last year at this point, because the changes that were taking place in the stock market were just accelerating. And I wrote the book before the pandemic. Post-pandemic only made evident that a lot of my hypotheses were right and were true, and they were just expedited in that the stock market is separating itself from its original intention, which is a means for companies to raise capital. And it's much more of a speculative space. There's always been a speculative component in there. But because access through free retail brokers that are web-based or app-based, and they give you access to stock options, they've only facilitated access. They've lowered the barriers to entry for people to trade.
What do you see as some of the biggest problems millennials face when they download an app like Robinhood?
When they download the app itself, or any part of the process between the downloading and the actual use of the software, I don't think that they encounter any problems. I think it's designed such that it's a smooth transition. They can have access to trading in the stock market as quickly and as easily as possible. Back when I started trading, opening a broker account involves printing forms and signing them and scanning them and sending them back, and having to wait several days before the funds are settled into the account. There was a higher minimum amount. These kids, I don't know what the requirements are, but I think they need to be 18 and they need to be a U.S. citizen, et cetera. And they can instantly start to trade. So mechanically, I don't think that there's an issue with downloading Robinhood or similar types of brokers. But I think when they start getting into problems, if we want to call it that, is when they actually start to trade. Trading stocks is a relatively simple concept. Very easy to explain to people that are new to it, which is you think something's going to go up or a company is going to go up in value, you buy it, and then if you're right and it does go up, you can sell it for profit. And if you were wrong, you can sell it for a loss or hold on to it or whatnot. Robinhood and these other free brokers, these app-based brokers, they're commission free. So and because they have no minimum requirements for funding, they're able to start experimenting and playing with actual money at a low cost. And they get into problems because they have access to tools that are more sophisticated, like stock options, that are much harder to understand, and they are much more sophisticated. They can be relatively simple, but they can also be extremely complicated. And that's when they start running into problems. The most simple of which is, they don't understand what they were doing and they lost some money. So they thought a company was going to go up and they buy a call option because that's what you buy when you think something's going to go up. And then they didn't really think it through. There were more factors. And even though the company did go up, they may have still lost money. That's the most basic problem. They can get into serious problems when they start experimenting with more sophisticated spreads or options combinations where you can buy and sell calls and puts and end up with these webs that are supposed to limit your risk in some cases, but in other cases have been exploited to end up owing more money than they actually started with.
What do you think are some of the biggest myths millennials tell themselves in regards to trading?
The answer should probably be well, I think I can make money and I'm going to do that. But I don't think that's the answer. I don't think these millennials or these younger generation retail traders are fooling themselves into thinking this is going to be a profession. I've seen time and time again and heard time and time again from people online that I don't know, as well as people in real life who straight up reach out to me for not investment advice, but gambling advice. They say, hey, I have 20 grand because I just ended up getting paid out on this bonus, and I don't mind losing that money. But I also want to try and put it into whatever I can that can potentially make me the most ever, because you can't turn $20,000 into a lot of money. So they come into this well knowing that they're playing because they're gambling, and especially when they start using these leveraged tools like stock options, that they have a high likelihood of losing their money. I think that some of the myths, it's not even a myth at this point. I think it's more of a fallacy takes place that once these guys start gambling and they start making money with this, their perspective switches and that optimism switches to, well, I was lucky, to I was talented or I was skillful with making money. And that's much more dangerous, because then they've already done it. Then they've already made money. Then they can have this self, what do you call it? The self-fulfilling bias of saying, this is what I want to do. And then they start ratcheting up the amount that they're risking and get themselves into more trouble that way.
You're talking to a Canadian here. We saw a massive cannabis bubble in 2018. Do you think we will see a similar cannabis bubble emerge in the U.S. once the U.S. operators have access to Robinhood?
I don't. I think that the bubble would have already taken place. There's already a lot of marijuana stocks, and there's a lot of ETFs revolving around those stocks. And all the craziness that we're yet to see, we've already seen a good amount of it. So if that bubble were to happen, it would have already happened. We did see it with some stocks. The only one that comes to mind is Tilray. I'm not that familiar with marijuana stocks, to be honest with you, but I remember that one because it had some massive moves where it went up a huge percentage, and it had this spectacular drop back down the way that some bubbles tend to do. But that was a specific company. You've seen individual moves for stocks. I also remember an episode where somebody posted on YouTube a video of a Coca-Cola can or something, and I don't know if it was true or not true, but somehow that can or the video insinuated that Coca-Cola was going to partner up with some cannabis company, and so you saw some big moves going on with that stock as well. So you'll see these little one-off things, but as a whole, the legalization of marijuana doesn't necessarily mean that any one marijuana company is going to be a victor in this business, nor is it proven that marijuana business models are actually profitable on the way that Wall Street likes to see.
How impactful do you think forums like Reddit are for moving markets? Should traders be monitoring these forums to have a sense of trading psychology?
I think that there's definitely an element of group mentality. Forums like WallStreetBets on Reddit or other ones on Reddit, as well as outside of Reddit, that they all try to identify what they call meme stocks, right? These are stocks that people post memes about. These are funny pictures or whatnot. And they're grabbing all the headlines, and they're able to get a lot of attention and end up moving markets. I would say prior to this year, it would have been very difficult for that to happen because at least with large cap companies, the amount of money that retail traders have is limited relative to institutional traders. And so they're less capable of moving stock prices for large cap companies. However, we have seen a huge shift because of the pandemic this year to a much more active retail base. So these are a higher number of individuals that are actually trading, and they're with a higher frequency. And so you see a lot more activity, and that does potentially have the ability to move the market if they were all to coordinate and go in unison. But I'd be hesitant to point to any single source of this. A lot of times you have companies that whose stock prices move a lot based off of some news related incident. And so, for example, when the pandemic started, once again, people were going to have to switch to Zoom in order to make the meetings, and people flocked to buying Zoom. That's less attributable to WallStreetBets and more attributable to the number of retail traders that don't really know how the stock market works. And they just say, well, this is going to be popular, I'm going to buy this stock. And this is a logical move.
How does social media today change the way companies need to tell their stories?
I think that one thing has become increasingly evident. It's somewhat of a joke, but it's also not, right? Which is, okay, so what's the name of the company? What's in a name really does matter. I made a reference to Zoom just a little bit ago. It turns out that when people were, retail traders were rushing to the market to try and buy Zoom, they ended up buying the wrong one. The ticker symbol for Zoom is ZM, but there was another company whose ticker symbol was literally Zoom spelled out. So people would buy that stock in flocks, and it had nothing to do with video conferencing. They just shared the name, and the stock ended up doing very well. In fact, they ended up outperforming the real stock. So people ended up making ton amount of money. Obviously, they got made fun of by big channels or big CNBC or reporters from Wall Street Journal, Bloomberg, whatnot, because they didn't know what they were doing. But I argue that it doesn't matter that they don't know, because they made more money than had they bought the right Zoom. We had another episode last week where Elon Musk decided to tweet to all of his followers that they should use Signal instead of WhatsApp because of some changes in their privacy policy. And people saw that tweet and they said, okay, let's find a Signal. And they looked up a company whose word Signal was in the name. And they bought that thing up and went up 122% or some ridiculous thing like that. The company, as far as I understand, has one employee, the CEO.
Oh my gosh.
And that's just because they got lucky with the name. There's been tons of examples of things like this before. These phenomena predated this millennial or these retail traders surge into the market. Something similar happened when Twitter went public, whenever they went public earlier in the decade or last decade. There was some company called Tweeter instead of Twitter, and that thing ended up going up. But nowadays you see these issues taking place. So it's kind of a joke, but it's not, right? So that whatever's in a name actually does. There's also been academic studies that prove that companies with catchy ticker symbols actually outperform ones that don't. And actually, that was in the book as well. That study was published. But outside of that, companies need to cater now to two different audiences. You have the audience that always existed. These are the more serious investors. These are the Warren Buffetts that care about the financials. And so they don't want to switch their messaging for those types of investors. They continue to be 3/4 of the market. So they can't ignore them. But there's an opportunity for getting the ones that are less serious, that are taking this more of on a lighthearted measure. So the traditional ones, they're going to see the financials and the quarterly reports, and they want to see that they're dealing with scandals appropriately and whatnot. And then these more amateur traders, they just want to see these names in the headlines. Quirky CEOs at this point is more valuable for a stock than their functions. We saw the same thing happen with Nikola, for example. The CEO was quite quirky, and he was getting a lot of attention from it. Elon Musk is extremely quirky, very entertaining, and obviously ends up doing very well. Lisa Su from AMD, same thing. You have these very engaged CEOs that have an unfiltered Twitter account, and they can just really enjoy these non-corporate, non-massaged communications that are speaking to just individuals that find it fun. And as we've seen, the more that people talk about a stock or a CEO, the more interest they gather, and so the stock just goes up because they have more interest in this particular thing. We saw not with the CEO, but we saw this headline effect with Hertz as well this year. Hertz declared bankruptcy, and so everyone sees Hertz all over the headlines, and everyone's talking about Hertz. And I have my theories as to why, but retail traders flocked to Hertz and they pushed the price up over 100% as well. So I think being in the headlines is pretty relevant these days.
Well, thanks so much for joining us on the show today, Jaime.
Hi, it was a pleasure to be here. Thank you for having me, Cassandra.
And to our viewers, let us know how you think companies should be telling their story in 2021 in the comments below. Thanks for joining us, and don't forget to like and subscribe.